What the F is this? Okay, so guys, there's no shortage. There's no way to explain today's data other than a single word. Today's NFP was horrendous. Horrendous. Absolutely horrible. Let's break this down. What's going on? What does this do for markets? And what does it do to my positions? I'm going to tell you right now, it's a red day for me. It's a red day for a lot of people out there as the market absolutely tanked on a terrible NFP report showing 114,000 jobs added compared to the forecasted 176. I want to break this down, and then I'm going to show you guys some fascinating charts that might obviously scare a lot of investors, including some of my listeners. So viewer discretion is advised for this video. Okay, so first of all, everything is down. Take a look at the S&P 500 down 2.4%, the NASDAQ down 2.75%, the Dow Jones getting crushed 1.7% down, and the Russell, poor old Russell, was just getting going and down 4% in a single day. But do you know what the craziest chart that I have seen all day today is? The VIX, the Volatility Index is up a whopping and horrendous 51% at the time of recording this video. Guys, the VIX being up that much is terrifying because the VIX is the volatility index, which suggests how much the market thinks the stock market is going to move on a 12-month basis. And it jumped from 12 to 28. So the stock market is expected now to be highly volatile in the next several months. At least that's what the market thinks. But I want to show you something. We're going to talk about stocks. We're going to talk about gold here today, which is also actually selling off, which is weird to me. We'll discuss that in a moment. We're going to talk about the Edgefinder and the top setups, the changes in that. There's so much to get into. We've got the commitment of traders data dropping later. It's a huge day. Let's jump into this. And I want to start out by just, first of all, walking through this data together. What is so horrendous about this and what has changed? Well, take a look here at the NFP, the month-over-month jobs data. And man, just horrendous. The 114,000 jobs added missed expectations massively. The red dot is showing our forecast. And if we could zoom in on this, that'd be great. Chandler on the edit. Check this out. So the forecast was 176,000 jobs. The actual came out at 114,000. A terrible miss. A lot less people than expected got jobs added. And that's coming down drastically from the last several years even. Look at this. This is well below the low at 150,000 jobs that we saw in November 2023 reported. We haven't seen a worse jobs number in a long time. But this bad jobs number, this is not, okay, the jobs market is cooling. This is the jobs market is struggling. This is different. This is different than all of this. This is all okay. You know, I said in the recent videos that I've done on this topic that if we saw, 200,000, 175,000 jobs added, that would be healthy enough for rate cuts to be good news. But this is not good news. This is terrible news, and it's horrendous. Again, the name of this video is going to be horrendous for a good reason. This number is terrible. And not only is it terrible, but look at this. You guys ready for something terrifying? Jobs data today was so bad that unemployment rate went from 4.1 up to 4.3%. Now, this is still a historically speaking low rate of unemployment, but it's rising. And not only is it rising, but it seems to be picking up speed to the upside, which unemployment going up is to the upside is not a good side. That's bad. So I'm not trying to sound like a doomsday person today, but this number, it was pretty scary. And the market is now changing a lot of its tone on a lot of different fronts. What do I mean by that? Well, rate cuts when the economy is doing okay is fine for the market's outlook. If we see, rate cuts coming in and the economy is just sort of modestly slowing, then that's great news. But if you see rate cuts because the Fed thinks it might have broken something and maybe people are expecting higher than, 25 basis points. In fact, let's take a look at that now. Check this out. For the month of September, let's make sure we got the latest print here and take a look at this. There is now, for the September meeting, yesterday it was completely flipped. Yesterday, it was very likely that we were going to see a 25 basis point cut, which was not threatening, right? A 25 basis point cut to the Fed funds rate in September was the best case scenario. It was, hey, we're getting cooling in the economy, but not crashing. But now we see a very pronounced probability for a rate cut to be 50 basis points in September. 50 basis points, as I've said this week, if this happens, if 50 basis points becomes the new norm, that's rate cuts for the wrong reasons. That's rate cuts because things are looking bad. And today, with today's data, the market is more afraid than it has been in recent weeks because this economic data, this cooling in the labor market, we're not worried about inflation anymore because now we're worried about the labor market. The labor market's got serious issues that are starting to rear their ugly head. Unemployment rates rising, unemployment claims are rising, jobs creation is slow, jobs openings, JOLTS job openings. We could go back to the Edgefinder and look at that. Job openings have been trending lower. Jobs health in the US is starting to show signs of breaking. And that's not good. That's really, really not good. Now, before we push on, I just want to reiterate that I'm not here trying to spread fear, but this needs to be called attention to because this is important stuff. The concerns have now risen for a recession for good reason. If you have the labor market really, momentum to the downside, that momentum could continue and could become a much bigger problem. So the VIX is up 47% now. I mean, it's all over the place at the time of recording this video. The Nasdaq's, down big on the day. But the question is, are these big buying the dip opportunities? And in my personal view, the answer is yes, but we got to be careful because this market may have more downside before it finds a bottom. And I've been early to this pullback. In fact, I've taken a couple losses trying to catch, the Nasdaq on a pullback. And with hindsight, I'm feeling really silly for doing that. But I do still like the probabilities that we do see a possible soft landing. And if we do see a soft landing, this is going to look like a very sweet, pullback to get involved in. But I'm not feeling especially confident about it today. Today, one thing that I'm feeling a little bit more confident about is actually looking for possible setups on gold. And gold initially jumped higher on these expectations for rate cuts to come faster because rate cuts for a recession, generally speaking, are kind of bullish for gold. If we actually enter a recession, though, gold would actually drop. Why? If you look historically speaking, when a recession actually kind of starts, people sell gold in favor of raising cash so that they can either, pay their margin, right? If you get a global margin call kind of situation, like 2020, we actually saw gold dip hard before it got bought aggressively. So there is possibility that we see some volatility on gold, but I still like the upside to gold if we get pullbacks. In fact, the Edgefinder is now giving us a bullish rating on the gold market. You can see here is gold showing up as a bullish reading with this recent economic data coming in very cool. Labor data has really ticked up score points for gold on the bullish side. So I will be personally looking for bullish setups again on gold, which is kind of exciting if I can get the right entry. I will, of course, share all of those updates inside of our Discord channel. Also, while we're on the topic, I just wanted to mention today we are doing our Edgefinder 55% off sale. Many of you guys might have heard of that, but today is the last day. So if you have not already picked up a copy of the Edgefinder, here is your final warning. First of all, this is the biggest discount that we do all year long. Our summer sale gets you access to the tool for a one-time payment, 55% off right now. If you click the first link in the description down below, you can speak to a member of our team who will get you set up with that discount code, as well as answer any questions you might have about the tool. So again, first link in the description. Don't miss it. Today is the last chance.
So last chance.
So if we take out the neutral readings, what you'll see is that our pickings here on the Edgefinder are pretty slim. You've got the gold market. You've got some dollar crosses looking interesting. Euro dollar, pound dollar getting bullish readings now. Gold's getting a bullish reading. Dollar CAD is getting a bullish reading. And then you've got dollar yen, which is getting a bearish reading, which I thought was really interesting because I have not played dollar yen at all. But if you're a currency trader, then you are definitely aware of what's been going on with dollar yen, which has been a fall off of a cliff recently here. And I'm not in this trade, but I am short dollar Swiss. And this trade, my goodness, the risk reward on this one has been massive. You can actually see, the risk reward on this is currently floating around a 9-to-1 risk reward. And this was shared inside of our Discord group. So if you'd like to join Discord, the link is in the description down below. But again, big sell-off in the dollar Swiss franc. Also, today on my live stream, I did mention something really important. I broke down the two different types of rate cuts that we could potentially be looking. I did a really elaborate drawing on my live stream today. So we're going to roll that clip so that you can learn hopefully something about the two different types of rate cuts that could be coming in September and what it could mean for markets. So check this out. So this is our first rate cut. Our first rate cut, let's just say, we know it's coming at some point. Let's assume September. Okay. Rate cut number one is sometimes considered like the inflection point, like the stock market's going to crash once you get there. Well, let's think about this. Let's say we have rate cut hikes stalling out where we've been. So if you get rate cuts that are slow and gradual, right? What would this suggest? Slow and steady rate cuts would suggest a soft landing. But then let's talk about scenario 2, fast rate cuts. Not good. Why? Because, so let's say this is scenario 2 and this is scenario 1. Okay. These are rates. We're going to do a full drawing here. So if rates go up and then they go flat and then they start coming down slowly, we would call scenario number 1 a soft landing, because what this would usually entail is that economic growth during the rate hike cycle, what happened was growth was pretty strong and it kept going. And then it sort of lagged the effects of the rate hikes. And now this is where we're at. Now, this is growth. Okay. The economic growth during the rate hike part was very strong. There's a ton of stimulus injected into our system during the COVID lockdowns. So much money came in, the reopening trade, inflation was hot, growth was hot, but then growth has started to slow. I would say we're right here. By the way, we are here. Let's get a unique color for this. We're right here. It's like when you're on that sign, or like when you're like at a like a theme park or like at a national park or something. Here's our you are here. You are here. Okay. We don't know what's going to happen. In fact, what I'm going to do really quick, I'm going to make these dotted lines because these are possibilities. Okay. Let's go 2. Okay. Growth was really strong. Started to taper off. And this is where we're at. If we get from here, growth flattens out into the first rate cut. If we get scenario 1, the expectation for growth would be for growth to expand. That's the soft landing, right? If rate cuts start to happen, growth stays good, inflation stays cool, then that's great. But if you get scenario number 2, where rate cuts are happening fast, that's because the economy, let's also make this, instead of just growth, we're going to make this eco/growth, because it's kind of the full encompassing economy in summary. If the economy is good, if it's hanging in there, then we'll see scenario number 1 be a great scenario, would be a soft landing. If you get growth falling hard from here, that is going to be scenario number 2. Okay. Scenario number 2 is the hard landing. Hard landing, soft landing. Today was a win for the hard landing camp, because today we saw economic growth hurt because we saw jobs data come in very, very weak, which would maybe suggest maybe we're seeing scenario 2 start to form. If we had seen really good jobs data today, the market probably would have celebrated, saying we're probably going to see scenario number 1 occur, which is more of a soft landing where jobs data stays strong, the interest rates start coming down, and growth actually expands. I still think that is a possible scenario. Today's singular print does not tell me, oh, it's time to get super mega bearish, hard landing for the win. I'm not changing teams entirely. You have to be careful thinking that a soft landing is guaranteed or a hard landing is guaranteed. We don't know. These are projections. These are ideas. These are forecasts. Something to think about. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.